We've had some extra pressure on us. Originally, the market on closes were looking heavily to the sell side. That's paring down a little. That may ease things. Part of this is technical breakdown. As you aptly noted, we were closed, and so we've got a kind of two-day buildup here. That's why it's somewhat severe. When they broke through the 100-day moving average in the S&P, then through 2,700, and we're trying to hold at the 50-day moving average down in here. The big concern is that much of this Italian debt is held by the Italian banks, and they are allowed to carry it at par. They don't have to mark to market. So if federal debt, if the government debt is treated as a par situation, they don't have to hedge it. And that's the big concern in the market, that most of it's not hedged.
Rick, in terms of the moves we've seen in the bond market in the last 48 hours, what does it take you back to in terms of memories? Is it as worrying as that 2010, 2012 Eurozone crisis type moments?
Well, in my world, actually, in certain ways it is. And I'll tell you what I mean. Back then, they had full ammunition. Mario Draghi's bazooka was loaded. The markets were ready to be bought. Now the markets have been bought. Pretty much the ECB's bought all the good paper in Europe and a good chunk of the bad paper. I think what's going on with Italy is huge, and maybe for all the wrong reasons. Many believe that it's not as nerve-wracking as the previous episode in 2007, 2008, because it's mostly political in nature. And in my world, I would think that makes it way more dangerous, because I think after Brexit, after the Tea Party, after Trump, the world has a raw nerve to it. And I think that the political class, the technocrats of Brussels, are going to put their thumb on the scale here. They want another election, and what's going on in the markets gives them a good excuse to go in that direction. But the more they go in that direction, the more it's going to create other unforeseen, unintended issues, because politics, at the end, is living a life that's different than global economics. You could call it globalism. That's a subset of what's going on. But I think it gets worse. And I think that the ECB is going to have a real issue as Mario Draghi turns over the reins. Hopefully, he wanted to move farther down the road of normalization. Italy stands right in the path of that.
Simeon, where does that leave you? Are there pockets here where you say, you know what, JP Morgan shouldn't be down 5%, 6%, whatever the case may be? Opportunities created by all this?
Yeah, I think there are definitely some opportunities. First, there's some hyperbole here. Everybody says, well, Italy's the fourth biggest sovereign bond market in the world. Yeah, but it's still only 2 or 3%. So contagion is somewhat unlikely. I think the opportunities that have emerged are certainly in the U.S. and the corporate bond market. Let's not forget that as spreads have widened, issuance has declined because there's a big tax change. Interest deductibility has been capped. So there's clearly an opportunity in U.S. bonds, maybe even high yield if energy prices stay high.
How much have those yields moved up lately?
Those yields in investment grade space have moved wider by 25 or 30 basis points. That's a big move towards almost cyclical median, so a real opportunity there.
Rick, I just want to come back quickly to the European bond markets, because as we've been discussing and as Simeon just said, it doesn't feel like there's the same level of contagion to the rest of Southern Europe. Yes, yields have risen there in Spain, Portugal, Greece, for example, but nothing like Italy and nothing like the contagion we saw during the peak of the Eurozone crisis. Is that fair?
Yeah, it is fair, but we have to remember that what's going on with Italy's recalibrated the, quote, air quote, good paper in terms of the boons. And those relationships are recalibrating all the other relationships. So even though what you're saying is true, I'm not looking at short-term funding problems. I'm not looking at seizing up of short-term credit. It is something different than that, but it doesn't mean that ultimately it's not going to hold the markets hostage. And I think that's what we're underestimating, what's going on with Italy. Basically, what's happening here is we are learning the hard way that policies create their own unintended consequences or reversal of policies. And those reversals are going to throw a real monkey wrench into the Fed, because there's not a whole lot they can do about it from their domestic perch trying to run our own country's monetary policy.
Art, what would you say to that, also considering the fact that we have had this move up in the dollar?
Yeah, no, I think Rick's right. If you look at the Fed minutes, they were already beginning to lean a little dovish. And with uncertainty around the world, they'll be slow to press the button.
Arthur, do you think that the U.S. bank CEOs will be concerned today when they see the moves in their share prices? They know some of the factors driving it. Are they concerned that there's more to come?
I think they're concerned with the way the market's viewing it, and certainly it's understandable in the European banks. The fact that it's bleeding into the American banks is a little tougher.
Simeon, going back to your point as well about how you think this is a little bit of a passing concern, what happens if interest rates stay down? So we're back around 2.75, round number, let's call it 2.75%, from over 3%. If for whatever reason, European issues or not, we stay down here, then does that justify re-rating the banks and other parts of the market?
I think maybe banks, but not overall. So if there certainly could be an opportunity to see the consumer sectors, both discretionary and staples, start to outperform. They've been real laggards, and tech valuations may be a little stretched. So in large caps, yes. However, look at the dramatic outperformance of the Russell 2000 today. Small and regional banks might catch a bid here because the normalization path of rates, notwithstanding if inflation comes down a little bit, but just the unwinding of the balance sheet could still give some opportunities for the small and regional banks to outperform.
What about an investment bank like Goldman Sachs? Will they actually benefit from this sort of volatility?
Look, volatility is always good for trading houses, not as much as it was given all the rules subsequent to the crisis, but there's always a little bit of an upside there. But this is a reminder of the difference between the big, large cap global banks and the smaller regional banks that don't necessarily react the same way to whiffs of potential contagion and can result. And we had good consumer confidence today, so the domestic story is still pretty reasonable.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.